When acquiring a business, there will be a number of considerations regarding the structure of the vehicle to acquire the business. The considerations that a purchaser will look at will include taxation consequences, usually a major factor, the simplicity and cost of the structure, the nature and size of the business, the risk management procedures that might be involved in that business, and the cost of removing the business from the vehicle at a later stage should the purchaser decide to exit. The potential structures a purchaser will look at for acquisition of a business are as follows. They are sole trader, partnership, limited partnership, trust, or a company vehicle. A sole trader structure is the most simple of the structures, but also has the one with perhaps the greatest exposure to liability for the purchaser. A partnership has some issues as regards flexibility, for example, the decision making associated with a partnership. And a partnership also has the feature that the partners are equally liable for the losses associated with the business. A company structure gives perhaps the greatest flexibility. However, the directors of the company need to be aware that they can be personally liable for insolvent trading and may be required to provide director guarantees associated with the business. A discretionary trust gives good flexibility for a purchaser. However, the assets associated with the discretionary trust may be at risk should the business fail. Asset protection is a means or a strategy adopted by a purchaser to reduce loss or attack on the assets should the business fail. Some of the asset protection strategies that might be adopted by a purchaser are the housing of certain assets in other vehicles. It would include risk management procedures associated with the business, and would also include review and ensuring there is adequate insurance associated with the business and the assets. Tax is often the driving factor in determining the structure for a business acquisition. For example, capital gains tax, the most useful structure, generally speaking, will be a discretionary trust. However, a company structure will be less flexible when seeking capital gains concessions. A purchaser will always consider carry forward tax losses and how they might be utilised. For example, carry forward tax losses can be claimed if there is satisfying of one of two tests, either the continuing business test or the same business test. Often a purchaser will require a business to be restructured prior to sale. The purpose of the restructure is to ensure that the assets, if possible, are placed in a clean vehicle, so if the purchaser acquires the vehicle, then the purchaser is not acquiring unwanted liabilities. The transfer of assets between companies as part of a company restructure may trigger the requirement for payment of transfer duty under the Duties Act. Relief may be available under the corporate restructure provisions of the Duties Act. However, this is a complex area and does require specific advice.